Hey, we'll get rolling in just a sec. Let some folks get in here. As you come in, be sure to say hello. Just making my tea and we will get rolling. All right, I'll turn the video on. Cool. All right, say hello as you pop in. Happy Sunday. I hope y'all are having a great weekend. We are going to be covering the 5 ways to avoid a bad deal. This was something that came up. I was hanging out with a couple friends that have done some deals recently. One who got financed by SBA, and another friend of mine who acquired a business in the sneaker space that decided not to do SBA. So we're just talking pros and cons. And one of the person that used SBA pretty shortly after he did an SBA deal, and he's a subscriber, so he'll probably watch this, but he jumped in an Uber randomly, starts talking to the Uber guy about his background, blah, blah, blah. And of all people, this is literally like 60 days after he just, signed on the dotted line, has this $1 million liability, but also asset that he acquired with the SBA loan. And this Uber driver goes into a story not even knowing anything about my buddy, about how he bought a business, he used an SBA loan, the business didn't go well, and he ended up shutting it down. And this is the part in general, the overarching kind of theme of our conversation was this whole thing around, a lot of people don't talk about the downside to deals because there's nobody that has a vested interest in talking about that. And anytime you try to say anything bad about anything, people, I don't know, they just attack. So even like me, I talked about micro-acquire, just facts about micro-acquire. But as soon as I say it, it's like, no, you're saying that that's bad because you're trying to do something like this. Like, what's the benefit that I get out of that? Like, there's just no benefit. Nobody talks about the downside and the risks and all that. Like, obviously you have brokers who want to sell you deals. You have trainers that want to convince you that this is this get rich quick scheme. So, because they want to sell courses. And so there's just no real, the book writers want to sell books. Everybody is really motivated to just say, oh, all of these things are great. And, unfortunately, there ends up being people like my friend's Uber driver who had a great amount of money, had his life savings, took on debt to buy this business. And one of the biggest downsides to SBA, while I am a very big fan, if you are experienced. You've got a great team around you. Every I is dotted, T is crossed. Like there just can be no room for error because an SBA loan has what's called a blanket lien. That means that if the business goes wrong, and we just know the statistics, like if you don't have everything perfect, the statistics are against you if you have everything perfect. So you have everything completely perfect. And the odds are just still against you because 50% of businesses every year just going out of business. So when you're taking on this amount of debt, you want to make sure everything is perfect. So this individual, he felt like everything was great. The deal didn't go right, and since the SBA has that blanket lien, it basically means they can go after anything. They go after cash that you've got. They go after your cars, your house, just assets, stocks, accounts. They can literally come after anything. And then once you do start to make money, they can garnish your wages. So sorry about that. In the middle of downtown, it's a little noisy outside. But this is why it's so important to do the right deal, have everything, not just in order from the standpoint of the business that you're buying looks good, but you've got a plan to double, triple, quadruple that business. We don't even, most of the time, and this is one of the toughest things to teach people when we're doing private equity deals. When we're going through due diligence, we're not trying to figure out due diligence for the business today. What we're trying to figure out is what are the opportunities, what are the assets, what are the resources that we can leverage today to take this to another level. It's kind of taking the perspective of even Lean Startup, which is a great book to go back and check out. So with Lean Startup, the idea is, you're starting to get the thing profitable with as little as possible. The best acquisition and the attitude that you have to take is you have to look at that business as just a foundation. It's just a head start. You should have no less hustle and no less vision for that startup or for that business as you would if it was a startup that you just had to start from scratch. It's just that you get the benefit. You get the benefit of some customers, you get the benefit of some income, you get the benefit of employees. You have all these benefits. But the real goal at the end of the day has to be very, very simply that you're using those assets and resources and systems and all of that to grow that business like you would have started. It's just a head start. It's like, oh, great, I'm going to start this thing, but I'm already on the train that's moving, so I don't have to start from scratch, which is a benefit. And when you take that attitude, then anything that they have in that business just becomes like, wow, this is great. I've got this additional upside when I get in here and start to create and grow this asset. So let's talk about my 5 things that are just, when I'm looking at the deal from the very beginning, I'm trying to figure these things out. So the first thing is scalability. And for me, what that means is, again, what I just talked about. I'm not so much concerned about, hey, is this business going to continue the way it is right now? It's me looking at it with that entrepreneurial lens to figure out, all right, wow, they've already got these customers. I know that I can sell this additional product to those customers, or I know that I can improve the marketing that's going out right now to get more customers. And so you're coming in and you're ready to explode that business. So many people get into a business and their vision is just, hey, I want to continue what that previous owner was doing. And so with scalability, you're looking to scale that business up using what it has, which is important, but it's not just focused on that particular business as it sits. Which, by the way, if you are looking for a scalable opportunity, be sure to hit us up, broker@goodmerger.com. We are in the midst of interviewing and talking to some potential new brokers. And, very just proud of my audience, man. We get some really amazing people. I continue to be impressed by y'all. Number 2, controllability and regulations. So, we're doing a deal right now in the lending space. And one of the people that was on a call today when we're discussing putting together this deal, it was talking about regulation and controllability and all of that. And you would think in a lot of cases, if you're getting into finance, there are a lot of regulations to be aware of, but you want to try to stick in the spaces where it's not highly regulated. And so, in some cases, I don't want to deal with a bunch of regulation. So if you know that going in, you can filter out your deals and just say, hey, like if there is a ton of regulation, then we don't want to be bothered with it. In this case, there's essentially a franchisor that's already done all of that work, so we don't have to worry about it. But I would say for me personally, when I'm looking at controllability, I want to get as much control of the business as possible. Even when I'm investing a minority percentage, I want to have some bit of control. Now, in a lot of cases, I don't. I'm in multiple funds that I don't manage, and I get reports and that kind of thing, but I don't have any control over those. Obviously, I'm in the stock market, so I don't have any control over those. But as much as possible, especially in these deals, one of the big benefits is that you can have control. You're not at the mercy of what's happening in the stock market right now. You're not just like on the side, like, okay, I just hope that things get better. So the power of this is that you do have control, so you can go in and create this scalability to grow that business. And so for me, those are 2 really important things. I want to get into a deal where I can have an impact. And so, it may be that in a deal where I only have 10% of that business and I don't have control of the whole business, I'm still able to control my ROI. And that's the control that I want to focus on. I want to focus on the controlling my ROI, and I'm able to do that by having an impact on that business. When I invest in Tesla, there's nothing I can do that's going to have an impact on when that stock goes up or down. Like I don't have enough money to buy enough of the stock to impact the price. I'm not going to buy enough Teslas to impact the income. There's nothing that I can do. And so I'm at the mercy of the market. So with this, even if you're not in control of the whole business, you're in control of what happens in that business. So for me, I don't want to just have 10% and then sit back and pray like an angel investor would. The power of private equity is that we can go in and start giving recommendations. We could go in and say, hey, I want to take over this marketing campaign to improve it. Or I'm going to go out and find a joint venture partner so that we can promote to their audience that grows the business. So there's all of these things. Like you should just there's always kind of this controllability if you're doing a private equity deal, and that should be something that is just a part of the deal, where you're still coming in with that vision that we talked about in the scalability factor. So those are important. Scalability. I put control and regulations kind of the same, or as opposed to making those 2 separate. And then the next is what's my investment? Now, the really cool thing is, when you get into this space, you can use leverage, but like my cautionary tale at the beginning of this, you want to be careful with how you use leverage. And the key here with investment, one of the reasons that, people really undervalue, seller financing. That cautionary tale on the SBA side is one of the reasons that seller financing is so valuable. So even if I can get like 50% seller financing is more valuable to me than 99% SBA. Because 99% SBA, if things go wrong in the deal, they're coming after all my assets. And the more well off you become, the riskier that is. And so if you're, one of the things I say is like, hey, if you're broke, like, and you can't get an SBA loan, do that all day long. Cause hey, when they take everything, ain't that much to take. But the hope is you're kind of building wealth. And so it becomes more and more risky. The more equity you build, the more you save, all those things. But seller financing is just, man, it's so valuable because all that person gets if the business doesn't work is the business, which is, hey, that's perfect. It doesn't affect your credit. You don't have to file bankruptcy protection. Doesn't take, your home, your car, all the things that SBA will go after. You don't have to worry about, and that's just a major, major deal. Super important. So the value of seller finance. So when I'm looking at investment, when we take this number 3, the important thing there is, what am I having to invest holistically? Because people always just focus on their cash, and what you're investing when you take on an SBA is literally almost your whole financial life. It's your credit, it's all assets because of that blanket link. So that's what, for me, you could even change the investment to risk, but it's important to look at your investment as, what all am I putting at risk? It's not just the cash. So that's something that gets people in so much trouble. If you're trying to avoid, the acquisition is going to, wreck your financial life. And I because I have this channel, because people reach out, like, I get these stories of folks that, it's not just all roses and daisies. There are folks that really, ruin their financial life with one acquisition. And this is one of the reasons, is that they're looking at, I can get this in place. I can do this leverage buyout. I only have this much money invested. But you want to look at how, what is my overall risk that I'm putting up by doing this deal. The next thing is marketability. So there are 2 things that are important with marketability. The first is the obvious, what people think about. When you're doing a deal and you're looking at the business, you're thinking about marketability as far as what's the product in the business and how well they're selling it. That's important. But what's even more important from a private equity standpoint is the marketability of that business. So if you're getting into a business and that business is going to be very difficult to sell, it's not going to be attractive to buyers, that's something that can be a problem. If you're not going to be able to sell that business, that becomes an issue. So you want, it's not just the marketability of the service or the product that is being provided, it's the marketability of that business to be able to sell it when you need to be able to sell it. And it's almost kind of the liquidity. It means, hey, is this asset, even though it's a private asset, how liquid is it? If I need cash, how quickly can I get rid of this thing? So that's marketability. And then the last one I think is important, and was talking to a buddy of mine that actually just closed a pretty, 7-figure agency type of business. And, we're talking about the whole thing of, once you take on the debt, once you take on the risk, you make that acquisition. The scary thing is kind of twofold. On one end, it's, hey, I don't want to take my eye off the ball here. But at the same time, I know that I'm only going to be protected if I diversify. So I need diversification. But if I go get another business to diversify, now I've got to split my attention. So am I creating more risk while also lowering risk with this, with additional acquisitions? And the key here is this last number 5 is passivity. You want something that's going to be semi-passive, or at least be able to work. We talk about number 1, which is scalability. The goal is, what we do in each of the PEPs when we do an acquisition, is we will we'll have a 90-day sprint period where we grow that business very, very aggressively. We put our ideas in place. We test them, what's working, what's not. to get the business growth going. And then after the 90 days, the goal is, okay, we can kind of, everything's in place. It's putting the systems in place, getting employees in place so that there's a degree of passivity so we can go to the next deal. So you want something that is capable of being passive. Things that don't pass that test would be, if it's tied to you as an individual. People are going to be wanting your time, wanting your attention. It's hard to make those kinds of businesses passive. So those are the keys. If you pay attention to those 5 things in deals, you will get a little bit closer to finding that perfect deal that's going to be right for you long term, not something that's going to end up being a financial anchor. Hopefully that is helpful. Let's take a couple of questions and we'll get out of here. Cowboy del Norte, ¿qué pasa? What's up, man? It says, Ace, good afternoon, bro. Awesome to hear these insights, man. I appreciate you coming in. I want to try to always bring a balanced view where it's not just, oh yeah, everything is wonderful. Let's talk about the downside to these deals. There's no such thing as free money and investing without risk. John Yang, do you utilize seller financing? This is important. I don't do a deal that doesn't involve seller financing. And that's, this list could go on and on and on. But I talked about investment and from this perspective, but you should not be closing a deal that doesn't have seller financing on a lot of our deals, even if it's something where it's short term, like let's say it's a 6-month type of thing, or it's a 1-year type of thing. It doesn't have to be this loan thing, but it just allows you to get in that business. That seller is basically an investor in you and an investor in you doing the deal. And that just increases the likelihood that you're going to be successful. And most importantly, it decreases your true investment because you can structure those so that you're not taking on additional risk. It's just tied to the business, not tied to you personally. John, thanks for that question. John A says, okay. John says, is there a max on Sba loans? I think it's 5. I think maybe they raised it, but I know it was 5 million for a while, which is great because it gets you into a really, really good sized deal. But it does get you into a good amount of debt as well. Ever do a 100% seller finance deal? Yeah, so I have had those. Typically, what's going to happen in a 100% seller finance deal is that the seller's taking most of the risk up front, but you're agreeing to bloom them out pretty soon. So it's rare, especially in the market right now. I mean, I would just say it's great to get a seller finance portion, but it's just too easy to raise capital right now to try to get the seller to finance all of it. I think you can raise that equity capital. You can raise that outside debt capital that it's not SBA. Like that's kind of the interesting thing for me is I don't think you just don't need SBA. There's more, if you go back to the $68 trillion video that I did, I definitely recommend checking that out. But you just get the picture for the sheer amount of capital and this is literally before the crypto market is down, the stock market is down. A lot of people are pulling out cash, and a lot of people still want to find a place to put that cash, but they're scared to re-enter those markets. So you can do those, but I actually think you'll get better terms by having a little bit of equity. You still do a 100% deal, but raising that capital, there's just too much capital out there not to leverage that. Cowboy says, some sellers may shy away from seller financing. Always highlight their ROI and their overall benefit. Exactly. The goal, great thing with all of this is that your creativity is the limit. It's not like the stock market where it's like, okay, either this is going to go up or it's going to go down. And there's just nothing I can do with this. you're able to leverage unlimited creativity. And part of that creativity is how you communicate the deal to that seller. And this part that Cowboy mentions is an important piece of how you put together that offer and then communicate it. We'll take this one and we'll get out of here. Thank y'all for popping in. Really great questions. This last one, missed first part, but advice on first deal. What types of businesses that cash flow with seller financing? Nursing homes, internet businesses. So I think I love nursing homes. Those are really great businesses. I'm agnostic as far as industries. We've done deals from finance, just in this last year, to animation, to retail, to franchise units, as a lot of y'all know I'm a big fan of. So it's just everything. And in my life, it's been everything from spas to subways. It's just everything. So, but I will say that, I think the multiples, I mentioned this before, multiples are going to be high when it comes to internet deals. And so you want to make sure that you're getting a strong, a business at a strong multiple, like, no more than 3. Now, the really cool thing is where we've been focused is offline businesses that can be run by someone wherever they are in the world, and all that's already been set up. So we're doing a deal right now where the business is in Arizona, but the owner has been running it for the last 2 years from Pittsburgh. So, it's like, how much different is that than internet? So you get the best of both worlds. And, in that case, the business is getting a very great multiple, of last year's earning. Actually, it's less than a 1 multiple of the actual earnings for last year. So, that is I just think it's so worth it to look into deals like that. Awesome. All right. We'll end on this one, Martin. I certainly appreciate that. Martin Davila popped in, says, great stuff. Certainly appreciate that. Listen, subscribe to the channel. I'm going to continue to provide value, free information in this space. I want more of you to do your first acquisition. I think that it's a better path than trying to buy a business. But I also do recognize that there are a lot of risks. And so I want to protect you as well. So subscribe, leave comments down below. I'm doing these lives on a little bit more regular basis and leaving some time for questions, but most importantly, digging into the tactics and strategies. Certainly appreciate it. All right, y'all enjoy your Sunday, subscribe. And if you're interested in becoming a merger specialist, shoot us a message to broker@goodmerger.com.